Okay, let's see about articles. Let's see what articles we have tonight. Okay. Hmm. Is it really time to give up on Roku stock? Roku stock pulled back more than 25% after more than doubling between late 2022 and late 2023. Adoption of Roku's platform continues to increase in the US and other countries. The recent price pullback may leave investors questioning their decision to stay with the stock. Roku is arguably one of the more frustrating stocks for investors. After reaching a high of over $490 per share in the 2021 bull market, nearly all of these stash gains were wiped out in the subsequent bear market. Investors saw some recovery in 2023 as Roku's price more than doubled from the December 2022 low of $38.26 per share, but the stock still trades 83% below its all-time high at a time when other digital advertising-related tech stocks have shown more robust signs of recovery. Also, after briefly earning a positive net income in 2021, Roku returned the losses and it shows no signs of becoming profitable. Is it time to give up on Roku? The state of Roku. Here we have. Even Roku's detractors cannot deny that the platform continues to grow in popularity. So, in the third quarter of 2023, active accounts reached 76 million, a 16% increase in 1 year. That led to 22% more streaming hours as users increased their time on the platform. This growth occurred because the reach of Roku continues to increase. The Roku operating system is the number one OS for TVs in the US, and nearly half of US broadband users have a Roku account. Also, the popularity is not limited to the United States. Roku is also the best-selling OS in Mexico, and it continues to expand across Latin America and European markets such as the UK and Germany. Roku's financials. Unfortunately, this success is not necessarily translated into a solid financial performance. The first 9 months of 2023 revenue of $2.5 billion rose by 11% from year ago levels. The fact that yearly revenue rose 20% in quarter three may indicate some degree of recovery. Nonetheless, other parts of its income statement point to further pain. A significant operating loss meant its overall net loss increased to $631 million during the first three quarters of 2023. Roku lost $261 million during the same time frame in 2022. Yearly revenue rose 20% in quarter three may indicate some degree of recovery. Nonetheless, other parts of its income statement point to further pain. A significant operating loss made its overall net loss increase to $631 million during the first three quarters of 2023. The income statement also shows rapidly rising operating expenses, mm, which increased 31% in the first three quarters of the year. By looking more deeply at operating expenses, one can see where Roku spends heavily. The aforementioned moves to increase its presence may partially explain the higher sales and marketing expenses. Moreover, Roku competes with companies such as Alphabet, Amazon, and Samsung in this space. Hence, the increased spending on research and development may be an attempt to compete with peers. Still, the stock shows some indication that investors may be losing patience with the company. Despite the rising stock price for most of 2023, Roku stock seemed to run out of steam in early December when it reached a 52-week high. Since that time, the stock price has dropped about 25%. Okay, the decline has taken its price sales ratio to 3.5, comparable to where it traded after its 2017 initial public offering. So, when Roku's value proposition was not as widely understood, such levels could point to a buying opportunity, but they also imply that investors are not buying into its strategy, which could bode poorly for its stock going forward. So, should investors stay bullish on Roku stock? Given the state of Roku, we're probably premature to lose faith in the stock. Admittedly, the losses are disconcerting, especially considering the 20% revenue growth in quarter three. However, the high operating expenses are likely investment in the company that should pay off for Roku longer term. Moreover, the 22% yearly increase in streaming hours is a sign of the platform's growing popularity. The bodes well for Roku as the ad market continues to recover and should eventually translate into gains for the entertainment stock. So don't give up on Roku stock yet. It's still got potential, and it's still premature to determine that it's not good enough or anything, but it's still got potential. And uh, the fact is that it has gained a lot more viewers than a year ago. It's non-fact, right? And that streaming hours has also increased. Uh, Users has increased, and overall, everything has gotten increased. But then there's a lot of competition going on. Because there are like Samsung, Alphabet, and like there are competitors who spend a lot of money on R&D. But still, they are like number one in terms of uh, what is it? You know, operating system, TV operating system, and it's got the largest share in this market. So don't give up on it yet. Hmm. Uh, should a beginner of a is AT&T a value stock? iShares Bitcoin Trust or actual Bitcoin tokens? Hmm. Coinscup a millionaire maker. Wait, Coinspace Berry prototype put up amazing numbers. There's still so many questions. The technology might be more successful than the stock. AMD, we got Microsoft, Palantir. Estimate of your future social security benefit. My top three artificial intelligence growth stashed by now in 2024 and hold long term. Okay, we got Nvidia here, Amazon here, Datadog here. Let's see. NVIDIA graphics processing units already gold standard in running complex data center workloads like artificial intelligence applications. The company has regularly achieved the top scores at the MLPerf benchmarks, the industry standards benchmarking the performance of machine learning hardware, software, and services across training and inference user cases. NVIDIA holds more than 80% market share in AI ML chips, according to analysts. However, the company is truly formidable because of its full stack strategy. To elaborate, NVIDIA has extended its data center hardware portfolio to include networking equipment and central processing units purpose-built for AI, and both have become multi-billion-dollar business. The company has also branched into subscription software and cloud services to simplify the development of AI applications, and those products have become a billion-dollar business. Management sees those three adjacencies: networking, CPUs, and software and services as key growth drivers because they extend its ability to monetize AI. Additionally, with products addressing every layer of the AI stack, infrastructure, software, and services, NVIDIA is an even more compelling option for businesses. To that end, CFO analyst Jalozino believes its full stack AI software capabilities provide an incredible competitive advantage. Grandview Research expects the GPU market to grow roughly 28% annually through 2030. When coupled with growth in other AI spending categories, that tailwind could translate into annual sales growth above 25% for NVIDIA, which makes its current valuation of 30.9 times sales seems tolerable. So, as a caveat, that multiple is a premium to the 3-year average of 23.5 times sales. Investors with a 5-year time horizon should still consider buying a small position today. NVIDIA will probably command a premium valuation for the foreseeable future. Amazon operates the largest e-commerce marketplace in North America and Western Europe and has become the third largest ad tech company in the world. The company is using AI to make both businesses more efficient and profitable. For instance, Amazon uses ML models to optimize inventory and logistics routes, and they recently launched a generative AI tool It helps brands create marketing content. However, Amazon is truly primed to monetize AI because it has a dominant position in cloud computing. Indeed, Amazon Web Services accounted for 32% of cloud infrastructure and platform services in the most recent quarter, while its closest competitor, Microsoft Azure, held 23% market share. I mean, AWS is arguably the cloud provider best positioned to support businesses as they experiment with AI. Its status as a leader in cloud AI developer services makes that argument even more credible. Additionally, AWS has launched new generative AI products. Amazon Bedrock is a cloud service that supports the development of generative AI applications. And Co-Whisperer is an AI-enabled co-pilot for software developers. And the company also announced Amazon Q, a generative AI business assistant that can automate tasks and surface insights across a range of systems and data sources, including external products from Microsoft and Salesforce. So with that in mind, Morningstar analysts expect Amazon to grow sales 11% annually through 2027, driven by particularly strong momentum in digital advertising and cloud computing. So the estimate makes its current valuation of 28 times sales seem fair, especially when the 3-year average is 3 times sales. It's commonly seen as a benchmark for the broader US stock market. The index dipped into bear market territory on January 3, 2022. A drag down by recession fears rising from fierce inflation and the expectation of aggressive interest rate hikes. It declined by as much as 25% before reaching the bottom of the cycle trough on October 12, 2022. At that point, the S&P 500 began moving higher again as the investor sentiment shifted in response to cooling inflation, other signs of economic resilience. In 2023, excitement surrounding artificial intelligence also contributed to upward momentum across the stock market. The S&P 500 finally hit a new record high on January 19, 2024. The first time it had done in more than 2 years. By crossing that threshold, the index officially entered the bull market territory, and history suggests that more substantial gains are on the horizon. The stock market is headed much higher. Since the S&P 500 index was created in March 1957, it has run through 10 bull markets. The chart below provides details on each event, including the start date, peak gain, and duration. It also shows the average gain and duration at the bottom. As shown above, the S&P 500 returned an average of 84.1% during the last 10 bull market, and it realized those gains over an average of 1964 days. To make sense of that data, we must first define the start date of the current bull market. The most conservative definition says two criteria must be satisfied before the S&P 500 officially enters a new bull market. First, the index must rise 20% from its cyclical low. But countless puts and takes influence those variables. Those include macroeconomic factors like inflation and interest rate, as well as macroeconomic factors like the financial performances of individual companies and the behaviors of individual consumers. Consistently making accurate predictions about any of those variables is impossible, let alone all of them. So guessing how the S&P 500 will perform during any specific period is even more difficult. For that reason, rather than isolating individual time periods, investors should consider historical returns across all market environments. The strategy can provide better insights to what the market's future performance might be, simply because it incorporates more data. It may be useful to analyze historical performance across shorter time horizon. For instance, the S&P 500 has returned an average of about 10.1% annually over the last 3 decades. It's reasonable to assume the S&P 500 will compound at an annual rate of 8.6% to 10.1% over the long term. Okay, I'm gonna do it really short. It's already 16. It's been 16 minutes, but it's 12:04 at night. So see you and have a good night, everybody. Bye bye, everybody.